If you are looking to refinance in 2023 and you've talked to someone who's convinced you it's a good idea, you may be sold a bag of goods. Please stay tuned to this video. In this video, I'm going to talk to you about things to look for and things to consider before you go refinancing. Because for 90+% of you who are looking into refinance, it probably doesn't make sense. Stay tuned. All right, Matt, the mortgage guy, residential mortgage broker, licensed across the country. If you want to connect with me and my team and get some good advice, whether it's refinance or purchase, go to greatmortgagebroker.com. You know what a great mortgage broker does? A great mortgage broker gives you great advice. This is going to be a little bit of a rant because it just grinds my gears to no end when I see people being taken advantage of. And I don't know if there's any better way to put it than taken advantage of, because average consumer doesn't have a degree in finance, doesn't really know what they don't know. They can be sold on something that can be very detrimental to their financial future. And in the mortgage business, especially in 2023, unfortunately, when times are a little bit leaner, a little bit tougher for a lot of mortgage companies and a lot of individual mortgage loan officers, people are desperate, right? And so this video was born out of a conversation I had with a client who was a week away from closing on a refinance because somebody told them it made sense. When we really dug in, I said, listen, if a refinance makes sense for you, I'm happy to write you a refinance, and I could even give you a better deal than what's being presented here, but it just doesn't make sense for you. And unfortunately, I've got data that I'm going to share with you that shows you certain companies actually go after refinance really, really aggressively. And it shows in prepay speeds. All of this stuff is documented, right? Like, how fast do these borrowers prepay? And you can even see the spread between their current rate and the new rates. You can see if there's incentive or disincentive. Right now, with rates higher than they've been in a long, long time, there's a huge disincentive for people to refinance. Yet there's companies out there that are writing a lot of refinances, and you know they're writing a lot when they're writing 5x, 10x what other companies are doing. That is done on purpose. It's not done on accident. It's predatory. Don't let that happen to you. Here's what I'm going to tell you. If you have a very good reason to refinance, let's say it's out of necessity. Unfortunately, there's a divorce situation going on. Someone's got to come off title. Somebody's got to get paid off. Maybe it's a have to do it type of refinance. Okay, I understand. There might be another circumstance where there's a paid off home and you're going to pull out $200,000 in equity. You're going to be able to go out and get a 20% return on an investment. And sure, the rate is 6.5 or 7% on that cash out refinance, but you're going to go out there and you're going to get great returns, a great business opportunity. I talked to someone recently who's opening a grocery store. He's opened them in the past, knows what he's doing. It's going to be a great investment, right? So there's some of those circumstances that make sense. Here's one that doesn't, right? Just talked to somebody who was in a 2-1 buy down that they literally just got 4 months ago. And in this 2-1 buy down, it was set to be 4.5%, then 5.5%, then 6.5%. Year 1, year 2, years 3 through 30. What this person told them on a phone conversation and inevitably got them, into the process of refinance was that, hey, we're going to refinance you into a 5.75, but you never have to worry about that year 3 going to 6.5. Not only were they baking in a lot of costs, not only is it likely a bad decision because that person's mortgage in the short term is going to go up by $350 or $400 per month, but they were disguising it by saying, look, your payment's just as low as it is in year 1 on this other 2-1 buy down that you're currently in. Except for that, they were underestimating the property taxes by $250. What they were also doing is taking this person from 90% loan to value to 92, and mortgage insurance was going up, right? The moral of the story is there's certain companies, and without naming names, the data is absolutely clear. Rocket Mortgage and Better. Those two companies are writing more refinance than anybody. They're writing refinances on people with a really big disincentive. The average rate spread is 2.5 or 3% higher than what they're currently in. And data doesn't lie, right? When I look at it and I look at, a measure that some of these data analysts use, which is CPR, Rocket paid an 8 CPR and Better paid a 20.5 CPR. It's like an annualized share of a group that prepays. Way too nerdy for you or me to really understand. Just know that when, a quality company like UWM has a 5 and Better has a 20, which is 4x that, it's because they're doing things like this Better loan officer had kind of tried to do with someone who reached out to me, who was a past client of ours that luckily we were able to save before they signed on the dotted line and got themselves into a bad refinance. In closing, let's just talk about scenarios that you want to avoid. If you owe a good amount of money, 300, 400, 500,000, and you've got a 2.75, a 3%, a 3.25, you better have a really, really good reason for pulling out 50,000, 100,000 in equity, because you're not just paying the higher interest rate on the 50 you're pulling out or the 100 you're pulling out. When you go from a $500,000 loan to a $600,000 loan, you're paying that new higher 6.5% rate on all of the 600,000. That is a huge increase to your mortgage payment. I talked to somebody recently, great gal with a VA loan, who was considering doing a cash out refinance. Current VA loan is 2.375. Avoid refinancing that unless you absolutely have to. Go out and get yourself a home equity line of credit if you want to go pay off $20,000 in credit card debt, if you want to do something and finance something separate. But don't touch that first mortgage. That's the best advice for the vast majority of you. Now, if you're watching this video in 2024 or 2025 and you're sitting in the 6.5% and current rates are 5.25, whole different story. The people I'm talking to are the ones that have 2.75, 3%, 3.25. They're considering a cash out refinance, or they're being told. Here's another marketing trick, right? I heard that Rocket had a script. Heard this from the inside, where they would take somebody, they go, you know what? I understand you have a 3%, but tell me about the Home Depot card. Tell me about the Lowe's card. Tell me about Kohl's. Tell me about that car note you have and the student loans. Okay, your blended rate is actually 9.4% on all that debt. So here's what I'm going to do for you. I'm going to do a cash out refinance, 6.99%. Don't worry, we're going to bake in 8, 10, 12,000 in costs. Don't worry about that. What they're really saying is, I'm getting paid as long as I can get you to the finish line. Don't believe the hype, right? Talk to somebody who has built their business on referrals, on doing right by the consumer. Go to greatmortgagebroker.com. That's where the best advice really lives. Thanks for watching. Hopefully this is helpful. Reach out, leave the comments down below. Each scenario is super specific, right? So I can't say it's bad for everybody. It's only good for these folks, because really out of 1,000 scenarios, there's going to be 52 that make sense. But there's also going to be 948 where I say, do not do that refinance. Thanks for watching. If you like this video, there's other videos on this channel. There's some here and here and here, 800 or so. I've been doing this for a decade, video after video. So like, comment, subscribe, do all the things for all this hard work.